Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307 264 9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is an author and the CEO of Gavacal, a financial services company based in Hong Kong and China. We're going to be discussing the impact of China's economy on the commodities sector, get his thoughts on gold, silver, energy, and much more. It's Louis Gov. Welcome to the show.
Thanks so much for having me again. It's a pleasure to be back.
Yes, I've interviewed you a couple times on the VRIC channel, and I wanted to get you on this show as well. So I'm very excited to chat with you. I want to kick things off with just more of a broad view of markets and geopolitics at the moment. I'm wondering, what are the main themes and trends that you're watching that you think investors should be paying attention to right now?
We could speak 2 hours on just that question. Look, I think there's both short-term and long-term things unfolding, uh, obviously reshaping the world that we're in. The first thing for me, so first of all, our company is based in Hong Kong. We have an office in Beijing, and we do spend a lot of time looking at what's happening in China. And what's been pretty clear in China for the past 4 or 5 years is that the government has decided to dramatically shift their growth model, right? They've decided, okay, we're no longer going to be based all around real estate. And you see this through the collapse in bank loans into real estate. And at the same time, the government told the banks, anybody who wants to borrow money to build cars or build solar panels or build turbines or anything industrial, go ahead and lend to them. So you see an absolute surge in industrial loans and a collapse in real estate loans. And here we are 4 or 5 years later, and sure enough, China, which already was an industrial powerhouse, is now just gaining market share everywhere around the world. From nowhere, China is now the biggest car exporter in the world, the biggest earth-moving exporter. They're out there now building power plants all across the Middle East, and this is business that used to belong to the Europeans, to the Japanese, to the Koreans. Now, I think Japan's response to this has been to let the yen go, right? And that brings me to perhaps the issue of the day is, where does the yen end up? Because today, as we speak, the yen is at 158 and against the US dollar, and that leaves it roughly 40% undervalued on a purchasing parity basis. Now, you could say, well, that happens. I've seen the South African rand and the Indonesian rupiah be 40% undervalued, but it doesn't happen on G3 currencies. It just doesn't happen on massively, important economies. Japan is an industrial powerhouse, so to have a yen that cheap has, I think, macro implications, and I think we've just seen one of them. If you look at the U.S. GDP print that came out last week, it was a disappointing print. And the disappointment all came from the foreign trade element of GDP. So what's happening now is, on the one hand, you've got a China that's super competitive and a Japan where the currency is massively undervalued. So where does that leave the US? Where does that leave Europe? It leaves them, facing some serious headwind for their industrial production, for their typical manufacturing jobs. So the natural response to this in Europe and the US is to turn more protectionist against China, right? And that brings me to, I think, one of the perhaps, for me, more interesting development of the past few weeks is we've had in the past 2 to 3 weeks, both Yellen and Blinken fly over to Beijing and to tell the Chinese, hey, stop being so competitive. In essence, so that's what they said, right? It's like stop producing more than us at a cheaper price. And what China just shrugs its shoulders and says, thanks for coming. I think your cab is here to take you to the airport, and they don't even drive them back to the airport. No officials, no red carpet, no nothing. So you've had two pretty disastrous trip. Especially, Blinken was never very pro-China. Yellen was. Yellen was always, oh, we can get along with the Chinese, etc. And usually, back-to-back disastrous trip, as we've seen, if you put yourself back 6 months ago, the Chinese stock market would have puked. Like any piece of news that was bad on China led to a puking of China. It led to a puking of copper. It led to a puking of energy. Again, put yourself back to where we were 6 months ago. We've just had, frankly, in terms of geopolitical terms, as bad a past week as I remember on China. And it wasn't just the yen falling; it was the bad Yellen Blinken visits. It was the arrest of of supposed Chinese spies in Germany. It was, you name it. It was a bad week. And against all this, Chinese stocks keep going up. And then I'll shut up now to give you a chance to speak. But what's fascinating to me in the past few weeks, where again the news flow in China has been relentlessly bad. Chinese stocks have been going up, copper prices have been breaking out, energy prices have been grinding higher. Uh, it all doesn't feel that bad at all.
Fascinating. And don't worry about answering for too long. Adam Rosenzweig holds the record for a 20-minute answer, and it was glorious. It was amazing.
All right,
So, hey,
I'll
the
give
more
Adam.
detail you can give.
Adam is a friend, so I'll state it now, right here at the beginning. I'm going to give him a run for his money.
Excellent. So I want to continue along the China theme there. You have a very unique perspective and insight into that country, having operated there for so long. I'm wondering how you see the Chinese economy shaping up in the future. We discussed this a little on the VRIC channel because there's always so many bearish headlines coming out about China's impending economic collapse, and you've kind of taken a contrarian view to that point. How do you see the Chinese economy evolving from here, and how will it impact the commodities sector in particular?
So first, I would say this being, the stories of China's about to collapse have been there my whole career. In fact, I moved to China in the early 90s, and I was studying Chinese at Nanjing, and um, I went to Shanghai for a weekend. And, this was in the days that you didn't have emails, you didn't have any of these things. So I was still writing letters to my parents, because also phone calls cost a lot of money back then. So I was still writing letters, and I wrote a letter to my dad saying, "Hey, look, I've been walking around Shanghai all weekend, and all the buildings are empty. This place is about to blow up. This is all a fraud. This is in 1994." And so, I think it's a natural reaction of a lot of people when they first come into China to look around and say, "Wow, this can't last." And yet here we are 30 years later. In the meantime, you've had a number of books written about the impending doom of China. I think the most famous was Gordon Chang's China's Coming Collapse, published in 2000, just before the place went bananas. So perhaps if you've been in China long enough, because you've always had this mantra of, oh, it's about to collapse, it's about to collapse, you end up tuning it out. I highlight this because it's a possibility that that I suffer from. It's if enough people say, oh, the end is coming, the end is coming, and it never comes, you tend to brush it away. Now, having said that, where is China today? I think we're 5 years into a real estate consolidation. And now what's fascinating, I've seen real estate consolidations before in my career. There was, of course, Japan in the 90s, Sweden in the early 90s, the US in 2008, Thailand in 97, US in 2008, Spain 2011. But this is really what makes China's real estate consolidation unique relative to these other guys, is this is occurring without an implosion in the financial system. Um, it's usually real estate starts to go down, and real estate's gone down about 25% in China in the past 5 years. Real estate prices start to go down, property developers go bust, and they've gone bust in droves in China, and then the banks end up going bust. In China, this isn't the case. In China, credit continues to expand. You haven't seen, if today you move to Shanghai, Beijing, or wherever, and you say, I want to buy an apartment or I want to buy a car, you can get a loan, no problems. And with fairly little difficulty. So the financial system has still worked, and as I said, it's worked mostly through loans into the industrial part of the economy. The industrial part of the economy that has been booming. And that brings me to another point, which I think is important, that I think perhaps people underestimate, is that as your industrial part of the economy booms, as you move up the value chain in terms of industry, you actually create higher value added jobs. So, you know, you take a textile worker earns less than half of an auto worker in China. So, as you basically shed the textile, the plastic toy, the shoe factory jobs into Vietnam, into Indonesia, into Bangladesh or wherever, and as you move up to producing cars, turbines, solar panels, you actually move up in terms of earning power of the workers, and with that comes better consumption. And so this brings me to, if you look at the Chinese data today, what you find is very much a two-speed economy. Everything linked to real estate is a disaster, but you have all-time record sales for restaurants, all-time record movie box office sales, record car sales. You know, it's the consumer is actually not doing that badly. And so you end up with an economy, you have the drag from real estate. So you end up with an economy that's growing roughly at 4%, with very low inflation, because again, everything linked to real estate has been such a drag. If your real estate prices are going down 25%, that's a genuine drag on inflation. So you end up with fairly low nominal GDP growth. But we have to remember that this was also a policy choice, that basically the government decided we can't have our whole growth around real estate. We can't continue to have real estate prices go up and up and up, because this is going to create social tensions as young people can't house themselves. It's going to create a big social split between the have who own real estates and the have nots who don't. And so, yeah, so bottom line, the Chinese economy is not imploding, just not growing as fast as we used to know it. And most asset prices have adjusted, fairly violently to this new reality. You've got an equity market that's dropped by half. You have bond yields that have dropped by half, from from 4.5 to 2.2, and you have a currency that's remained very stable, all in all, especially relative to things like the yen or the Korean won, China's big competitors. And then you have a real estate prices that continues to consolidate.
And then how do you see the consumer in China and their potential impact on commodities, as well as potentially Chinese infrastructure projects? They've got the Belt and Road Initiative. How do all these things factor into the commodities market? Because when China reopened after their COVID lockdowns, there was all this talk about how oil was going to spike, copper was going to spike. That didn't quite materialize at this point, although copper ripping right now, and we're going to talk about both copper and oil a little bit later more specifically. But how do you see the Chinese demand side of the equation when it comes to commodities up ahead?
Well, so the first, look, the drag on commodities from China has been that construction, real estate has been very weak, right? All the property developers have gone bust. And I don't think we can underestimate the impact that China's construction activity had on global commodity prices from basically 2000 to 2017, 2018. It was absolutely enormous. And that part has, it's basically stopped almost overnight. Now, what China's done now, China's impact on commodities is now a little bit different, and that what China's now doing is it's basically opening and creating new markets everywhere. You mentioned the One Belt, One Road, and this was my go-to line for years and years. China indeed has been building highways, canals, telecom systems, all across Asia, into Africa, and somewhere even sometimes even into Europe, and then to the Middle East, um, with a very simple goal in mind. Bring in commodities cheaper to push out higher value added goods to the outer realms of the empire. Um, this is what empires do. Empires are fundamentally a road construction exercise. That's why in Europe we say all roads lead to Rome. Empires want roads. Oh, that's why in Iran they used to say Darius is a traitor. Um, the first big Persian emperor. Um, that emperors, you want to bring in commodities cheaply, transform into high value added goods, and push them out. And this is what China's doing right now. China's cars is the best examples. China's come from nowhere to be the biggest car exporter in the world. Now, when I say that to Americans, when I say that to Europeans, they laugh at me and they say, "But I don't see the Chinese cars on the street." And I say, "Well, that's because you're not hanging out in Jakarta. That's not because you're not hanging out in Riyadh. That's because you're not hanging out in Lima or in Santiago." The reality is, China has created uh, a new category of vehicles, basically the sub $10,000 vehicles, and it's selling them all across the emerging markets. And that is the impact of China's on commodities that people are today underestimating. Um, because a lot of people look at this and say, "Oh well, so that's deflationary, right? China's producing less cars, so that's a lot less. It's deflationary for the whole world." The way I look at it is, I think, well, is it? Because now all of a sudden we've got a bunch of people in Indonesia, in Colombia, or in Saudi Arabia that are driving cars that never used to drive cars. At best, they used to drive mopeds, and now they're driving cars. And as they drive cars, they need more gasoline. That needs more copper, more rubber. Um, at a time when we've absolutely underinvested in the extraction of a lot of these materials. So the reality is, China's impact um, on commodities is perhaps now less domestic than international, in that China is allowing the broader emerging market space to industrialize very, very quickly and decently cheaply and on credit. All of which, if all of a sudden you help India transform into a billion consumers, you help the broader Middle East transform into 500 million consumers. You help Latin America transform into another 700 million consumers. All of this adds up tremendously.
Let's talk about gold and silver now. Obviously, putting in a very strong performance so far this year. I'm wondering what your thoughts are on the precious metals markets. Some are saying this isn't precious metals going up, it's fiat currency going down. Obviously, we've seen you brought up Japan earlier. We've seen countries like Japan, those who hold gold have had their purchasing power protected, which is what gold is supposed to do. What's your outlook for gold and silver at the moment?
Well, look, they're in a structural bull market, both of them. So in a bull market, you have two choices. You either participate or you look at it. You definitely don't short it. So the momentum is strong. Now, what's behind the bull market? The reality is, success has many fathers, and there's a confluence of forces pushing gold prices higher right now. For me, the first force is the emerging market bull market that I've been talking about. Never a number of pieces on this over the years, but I've always said that fundamentally gold is an indirect play and somewhat lower volatility play on emerging markets. And this is because, most of the people who buy physical gold happen to be in emerging markets. Roughly a third of physical gold demand is in China, another third is in India, another 20% is the broader Middle East, another 10% is Russia and the ex Soviet Union states. So, you know, the reality is, people in the Western world, in the US, in Europe, in Australia, they don't really buy physical gold. Like, nobody stocks physical gold, but people in emerging markets do. This might be for cultural reasons, like in India. It might be because they don't trust their government. It might be because they don't trust their banking systems. Countries with a high level of trust in institutions, um, you know, tend not to buy gold. Countries with a low level of trust in institutions tend to buy gold. So, and these countries with low level of trust in institutions are typically emerging markets. And so when emerging markets do well, people buy gold. And when emerging markets do badly, if you're a little cash squeeze, you sell your gold and it comes under pressure. So if you think of the big gold bull market of earlier this century, from 2001 to 2011, as the gold basically went from $300 to 2,000, that was a time of massive boom in emerging markets. China was booming, India was booming, everybody was booming. Um, so that's I think is your first fundamental driver. Now, to your second point, the a lot of I would say the gold bugs make the case that at some point people in the Western world will stop trusting their institutions because runaway budget deficits, because crazy monetary policies, because poor bank regulation, and that when this happens, then gold will go parabolic. And it could still be. You could still say, look, when I buy gold, I buy a sort of call option on people in the Western world losing faith in their institutions. And I would say for now, this has not happened. This has not happened. For now, all you've seen in gold is the emerging market part of the bull market. The surge in demand has come from China, it's come from India, as those economies have bounced back, but also as the governments have pushed money into those systems. Now, having said that, I think the move from 2000 to 2400 that we saw, the catalyst might well have been in Japan. And it may have been a sort of an indication of this very, oh, we're going to lose faith in our institutions. Because what happened in Japan, everybody, if you go back to early March, everybody was expecting the BOJ to give up on yield curve controls. Everybody was expecting higher interest rates in Japan. And the BOJ came out, the Bank of Japan came out and said, yeah, it's okay. We're happy with these policies. We're going to, keep sitting on the yield curve for a while to come. And if you were a Japanese investor, your response to this was to say, oh well, I'm going to look for alternatives. I'm not going to just keep sitting here in yen, losing purchasing power. And you saw a big move into gold. The way you know it is there's an ETF in Japan, 1540. It's the equivalent of the GLD ETF. And all of a sudden, that thing started trading at a 10% premium to NAV, and volumes in it went through the roof. Now, the second thing that happened is that with the yen going down in late March, the Chinese central bank allowed the renminbi to move above 720, which means renminbi going down against the US dollar. They had always intervened at 720 to keep the renminbi, higher than 720, and all of a sudden they let it go past 720. And it was in essence sending the signal to the Japanese, look, if you keep devaluing the yen, we can devalue the renminbi. I think that was a signal the PBOC sent. And if you were a Japanese saver, I think a Chinese saver, you panicked and you thought, oh my God, they're about to devalue. So they all poured money into gold. And that brings me to an important point, which is that the amount of cash sitting in bank accounts today in China is at trillions and trillions of dollars. You've never had so much cash sitting in bank account, in household savings as you do right now. And so anyway, so if you were Chinese sitting on cash and you thought, oh, geez, they might start devaluing soon, you also poured into gold. And so you saw the gold ETFs in Shanghai also trade at huge premiums. Now those premiums have now come down. So you've had the big move. But again, for me, the gold bull market is a reflection of the growth in emerging markets, and I remain very bullish in emerging markets. Ergo, I am bullish gold. And yes, I take the point that along with your gold position, you have a call option on, policymakers in essence, or retail investors around the world following the path of the Japanese investors, starting to panic about where their monetary and fiscal policy sustainability outlook may be over the long term.
Copper has also been ripping around the same time frame as gold and silver. We've seen a lot of reports over the last few years about the growing demand. A lot of these reports focus on the green energy, renewable energy angle and how much copper that requires. Emerging markets, obviously another huge driver of demand. However, producing copper mines, extraordinarily few and far between, and the cost of getting a copper mine running is extraordinarily expensive and time intensive as well. Is that the thesis that we're seeing play out with copper? Is that why you think that prices have risen recently?
So that's an interesting thing. Look, like I said, I'm a roaring bull on the emerging market growth story. Um, I think people are underestimating the structural shift in the growth outlook for countries like India, for Indonesia, for the Middle East, for Latin America. Um, And so that leaves me bullish most commodities, partly because growth in emerging markets tends to be much more commodity intensive than growth in developed markets. Growth in developed markets focuses around a lot of services. Um, Growth in emerging markets focuses on consumption of, you know, frankly, air conditioners and refrigerators and automobiles, and it also focuses around infrastructure spending. So the fact that a country like India moves from 6% growth to 8% growth, um, and perhaps does so for the coming years, it's hard to that's going to have a big impact on commodities. So because of the demand side, I remain bullish on pretty much any commodity you care to throw at me. You can take the whole table of elements, and I'll probably be happy about it. Pick any code you want on the table of elements, and it'll work for me. That's one aspect. Now, I think if you look at the copper rally that we've had in the past 2 to 3 months, the it's almost as if it started, and that first quantum mine in Panama that that got seized, um, which I think perhaps was a sort of wake up call to the broader market on, hey, look, it's hard to get copper out of the ground. A lot of the copper is in jurisdictions that is so. Um, at the same time, you also had disappointing numbers from Codelco in Chile. Um, so you put it all together, and the message on the supply side was, hey, we're struggling to get things out of the ground, almost regardless of price. And so I look at this and I think, yeah, uh, the underlying demand is there, and perhaps the catalyst for the re-rating was the seizure of that mine in Panama, which was a wake up call. That plus you had Anglo American also uh, downgrade its production numbers. So you had a few things going on in February where it was like everywhere you cared to look on the supply, it was bad news. Well, unless you were long the copper price, but it was bad news in terms of the amount of production that would be coming out.
Well, let's shift to energy, another space I know that you're bullish on. I think when you look at it, it's hard to not be optimistic over the long run. I've spoken to a lot of people about oil and gas, and some are bearish. And the two kind of main themes that I see come up when I discuss energy with people who are bearish are A, they think that the economy is cooling and that will stifle demand. I don't know if they're putting the emerging markets into their picture there when they say that, but that is a theme that comes up time and time again. And then another theme, which I think was kind of made more popular by Doomberg, was that his opinion is that there's new technologies that can convert natural gas into oil equivalent, and that these technologies are going to start to become more commonplace as abundant natural gas in the US at cheap prices can provide an affordable feedstock. So I'm wondering what your thoughts are on those kind of two bearish scenarios, and how you see the oil space developing.
So look, it's the bearish argument on the demand or the bearish argument on the supply, right? So let's start off with the demand. Again, I'll go back. I think most people are underestimating the amount of demand that's going to be coming out of emerging markets for the years to come. Now, on the whole, the economy is going to be cooling. Here's what I see around the world. Uh, in the U.S. is running budget deficits of roughly 6-7% of GDP with full employment. Now, this is fairly unprecedented, completely unprecedented, to be running such stimulative fiscal policy in the face of full employment, but yet here we are. In France and across a lot of countries in Europe, France today is 5.5% of GDP, also with full employment, also 3 or 4 years into an economic recovery, also unprecedented. Um, Japan, you're at 4% of GDP. China is massively stimulating fiscally. India is massively stimulating fiscally. So you take any major economy in the top 10 economies in the world, and they're running fiscal stimulus of anywhere from 3 to 8% of GDP. Now, with this much fiscal stimulus around the world, why should I expect much of a slowdown? It's like everybody's spending money like it's going out of style. Um, it's right now, to me, when I see the amount of fiscal stimulus, it doesn't feel like it's the morning after with a hangover. It feels like the sailors are still on shore leave. It's 1 a.m. and they still have a pocket full of money, and they're spending it like drunken sailors. And so to think, okay, the party ends now when these guys still have money in their pocket. It's 1 a.m. And there's still lots of girls in the bar. To me, seems unlikely. So again, everywhere around the world, you are getting massively stimulative fiscal policies. Like, find me a country that today is running a restrictive fiscal policy. Uh, the answer is there isn't. And in fact, I think what's going to surprise people in the coming years, perhaps the extent to which China, which had been running tight fiscal policy, China was the one place in the world where they were sort of tightening because they were afraid of inflation, and they wanted to crush the real estate, etc. Even China's now thrown in the towel and is stimulative quite aggressively. In fact, today all around Beijing, there's rumors of more stimulus to come, which perhaps helps explain why copper's done well, and all these things. So I don't buy the all this to say, I don't buy the cooling demand argument. Not only that, but you could say, well, U.S. might start to slow down, Europe might start to slow down. The reality is energy use in most developed markets isn't that cyclical. It's people are going to consume gas, like people are going to drive to work, people are going to consume whatever they consume in terms of gasoline. It's somewhat price sensitive. When the energy prices become too high, people will put on a sweater in the winter and they will drive less. It is somewhat price sensitive, but it's not that economically sensitive. Where energy demand is very economically sensitive is places like India, places like Indonesia, places like Mexico or Brazil. But these places are booming right now. They're absolutely booming. Um, and Chinese growth is starting to reaccelerate. If you look at the city economic surprise indices, China's the one part right now is the one part in the world that is actually seeing the most upside surprises. For the first time in like 5 years, it's seeing more upside surprises in the U.S. So put it all together, I'm like, yeah, I don't buy the cooling demand, like energy demand going down. Quite the contrary. I think on the demand side, what we're finding out is, rather than the whole world going to electric cars, that's slowing down for a number of reasons we can go into if you want. But in an effort to not beat Adam's record, I won't go. I won't go into it right now. Uh, but what you're seeing is all of a sudden people are upgrading, like, oh my god, with artificial intelligence, with these high energy consuming chips, our needs for data centers are going to our energy needs for data centers are actually going to be much greater than people expected. You now have Microsoft, Amazon, Facebook, Google. They're all lobbying the U.S. government to say, hey, go out and build new nuclear power plants. We're not going to have enough electricity. So the whole like demand is going to underwhelm when you in fact are going to be getting upside surprises. To me, seems like a poor argument. So the second argument, Doomberg's argument that, look, supply will take care of itself thanks to technological gains, thanks to progress, etc. Um, I'm open to that idea. I am open to that idea because, to be honest, that is the entire history of capitalism, and we saw it again in a little over 12, 13 years ago. Prices went up. Everybody was running around talking peak oil, talking we're going to have all these issues. And instead of having peak oil, we had the shale revolution. This is the history of capitalism. Prices go up and solutions are found. The question is, and that's how we progress, and that's how we get economic growth, because economic activity is energy transformed. And so the more growth we can get out of one unit of energy, the better. And again, that's been the history of capitalism. Now, against that, I would say the problem today is that policy is pushing you in another direction. Policy today, for the past 10 years, has been trying to push you towards using less efficient uses of energy, right? If we look at the history of humanity, for 50,000 years, we do nothing. We die at 50 years old. We have no growth. It's very Malthusian. And just when Malthus starts coming up with Malthusianism, we basically start getting huge productivity gains thanks to energy. Industrial production goes parabolic. Our life expectancy goes parabolic. Lifestyles improve. And that's because we started using coal, then whale oil, then coal, then oil, then nuclear. And each time we move up the value chain and produce more and more energy with less and less effort. And nuclear was the very pinnacle. And then I think we got stupid. I think we just got plain dumb, where we say, you know what, yeah, nuclear is good, but instead of going super efficient. Let's go less efficient. Let's go back down the curve and go to solar and go to wind. Um, so look, I would love for Doomberg to be right. Don't get me wrong. I'd love for it to be right. Um, I genuinely don't believe that there's regulations and government pushing us in that direction. Number one. And I also don't believe that the prices are high enough yet to cause real pain in the economy, where all of a sudden the private sector, regardless of what the government says and does, comes up with these solutions themselves. And where the private sector says, you know what, I'm just going to do this because the margins available for me, again, like there was 13, 14 years ago when we came up with the shell revolution. So bottom line, I think Doomberg may well eventually be right. I would be really surprised if it was in the next 2 to 3 years.
And maybe a third bearish scenario that's a bit more of a black swan, but something I think for me personally, I've been a little concerned with is the possibility of some other sort of global lockdown occurring once again. If the powers that be decide there's a pandemic again of some kind or another, and we see travel restrictions, we see all that stuff we saw previously. What do you even think about that when you're putting your thesis together? Or is that just something that's kind of a black swan event that you don't worry about?
Well, so look, what you're describing is an artificial collapse in demand, right? Um, where we were like, okay, we could get there if the energy price gets high enough, and they feel like, oh my God, this is going to implode the economy, so let's slow it back down. Um, I would say that you know the first lockdown took everyone by surprise. We were told, "Oh my God, there's this terrible disease; it's going to kill everyone. Stay sheltered in your home, etc." And then pretty quickly, people figured out, "Hold on, this is a really bad flu. It's killing a lot of old people, but I'm going to be fine. My kids are going to be fine. Let me get on with my life." And at least sort of halfway rational people came up with that conclusion. Now, some of it came up with that conclusion 3 weeks in. We hosted a call for our clients looking at all the data we had at that point on progression and on mortality. And sort of 3 weeks into COVID, we said, actually, guys, this isn't that bad. And we started writing papers, etc., and about it at the time. But I would say, like within 3 months, everybody with open eyes realized, okay, enough of this BS. And the more, I would say, courageous politicians, people like Ron DeSantis in Florida or AMLO in Mexico. By the way, it wasn't a left-right thing because Sweden never shut down in the first place. It wasn't a left-right thing as it's often portrayed in the U.S. AMLO never shut down in Mexico, and he's a socialist and like being anti-capitalist his whole life. So it wasn't a left-right thing per se. It was a common sense thing. And so, having said this, I think if policymakers try to pull the same trick on people again, uh, fool me once, shame on you; fool me twice, shame on me, kind of thing. I think the ability to impose another lockdown will be extremely limited, and it will be practically impossible in emerging markets. Like emerging markets can't afford these lockdowns, and frankly, Western world can't afford them either, as we're now finding like runaway debt with we're finding out actually we we couldn't afford to be stupid back then, and we definitely can't afford to be stupid again now. So all this to say, I don't worry about another lockdown. I think if they try that again, you'll have armed rebellions in the streets. You'll have riots. You'll have like people won't stand for it. So if they want to collapse demand, they'll have to do it in another way. Uh, they'll have to do it either through personal carbon credits, claiming climate emergencies, saying, "Hey, look, for the good of the planet, you're only allowed to take one plane a month or one plane a year or whatever." Um, that's one possible avenue. So basically, a big restrictions on your freedom of movement and for the good of the planet. But why would countries like Saudi Arabia or Brazil or Mexico go along with it? I'm not sure that they will.
Right. Well said. Very, very interesting observations. I don't have so much faith in our home country of Canada and the citizens there in that sort of scenario, but
Hey,
I definitely agree on the emerging
hold
market
on, hold
side.
on. Credit where credit is due. Canada, indeed, the problem with Canadians is they're too kind, too nice, too polite. But, but we did have the trucker movement. They did stand up and say enough is enough, um, and and the trucker movement, even though Trudeau put the full brunt of government against them, blocked the insurance policies, blocked the bank accounts, acted as tyrannical as possibly anybody could have even potentially imagined in Canada. Um, they eventually won. They eventually won, right? The border was reopened, the vaccine mandates were dropped. Within 2 to 3 weeks, Trudeau had lost on everything he was trying to push through. So I know, look, the Canadians get laughed at for being too kind and too polite, but they did draw a line, and they did it in a very polite way. They did it in a very Canadian way. It wasn't the riots like Jan 6, but they drew the line and they held it.
Yeah, that is a good point. You did mention nuclear there. I quickly do also want to get your thoughts on uranium. This is a commodity that it's very tough to find someone with a bear case on. The previous bear case on uranium was, well, once the price rises to a certain level, Kazatomprom in Kazakhstan, the largest producer there and the largest publicly traded company in the world, when it comes to uranium, they're just going to open up the floodgates and they're just going to start producing. Well, now we find out that they missed production targets. They're probably going to miss production targets again this year and next due to a sulfuric acid shortage. It's the way they do ISR there. And that company in general has been a mess. It's a revolving door of management. Who knows what's going on behind the scenes? And this is a company that provides some 30% of the world's uranium supply, somewhere around there. Maybe it's in the 20s to 30. It's very, very high. Is there a bear case left for uranium outside of like the worst case black swan nuclear disaster?
So yeah, so you always have the nuclear disaster. That's your one bear case. Your second bear case is the one you highlighted earlier, Doomberg's belief that we're seeing breakthroughs of transforming natural gas into uh, much more easily transportable energy. Um, so if you can do that in a world in which you do have a lot of natural gas, why even run with nuclear? So that's your second bear case. If you buy, again, I don't buy the Doomberg story, but if you buy it, then why be bullish uranium? Um, the bullish story on uranium for me is a pretty simple one. Is I do believe that we've had a massive change in the zeitgeist in the past few years, where nuclear used to be a dirty word, and here perhaps the best illustration of this is Macron in France. Right, Macron as finance minister basically sold off Alstom and France's nuclear assets for cents on the dollar. He couldn't get rid of it fast enough. Then, as president, when he comes in, he says, "I'm going to shut down nuclear," and shuts down Fessenheim, shuts down like the big nuclear plants in France. Um, and then all of a sudden, Russia invades Ukraine, and then he wakes up to think, oh, actually, having a whole year's worth of energy in one container is actually not such a bad thing. And so, in his second presidential campaign, all of a sudden he's Mr. Pro-nuclear guy, having been anti-nuclear his whole career. And this shift in the zeitgeist of realizing that, hold on, having an energy independence with a fairly low level of yellow cake, it's not such a bad thing. And when you look at the price of nuclear, the other reality is the price of yellow cake doesn't really matter. Like the building the nuclear power plant costs a lot. The price of the yellow cake is fairly marginal. You can buy it whenever it happens to be cheap in the cycle. You can store it. And you can have 10 years worth of energy independence in front of you. So in a world that is more geopolitically divided, more geopolitically sensitive, etc., nuclear makes a ton of sense. And I think everybody's woken up to that fact except for the Germans. I think the Germans, as we saw during World War II, during World War One, they'll stick with bad policies even after well after they've proven to no longer make sense. And so they're in that situation. But leaving Germany aside, you've had a shift in the zeitgeist everywhere. Therefore, now, so that's your first change. Your second change is China is now going around building a lot of nuclear power plants, not just in China, but around the world at a very, very low cost. And so China could now be an energy exporter. per se. It's bidding right now to build nuclear power plants in Saudi Arabia. Now, I never thought that China would sell, be an energy exporter to Saudi Arabia, but that might be unfolding as we speak. Um, so I highlight this because if China starts to build nuclear power plants all across the emerging markets, that's perhaps a demand for uranium that people didn't really anticipate. Now, you mentioned the sulfuric acid of Kazakhstan. I think one of the issues there, Russia actually has a ton of sulfuric acid, but Russia's telling Kazakhstan, look, we'll sell you the sulfuric acid if you want it, but you can't sell that uranium onto Europe or the US. You can sell that uranium to China, you can sell it to India, you can sell it across the global south, no problem. So Kazakhstan is stuck in between a rock and a hard place where, they're stuck in between China and Russia. And in essence, Russia's saying, okay, you can produce uranium, you can sell it to China, but really nobody else. So what's the point of producing a ton of uranium, crushing your own price vis-a-vis China? Might as well, if you can only sell a part of your production anyway, might as well get the highest price for it as you can.
Well, Louis, this has been a fantastic conversation. Always enjoy talking with you. For those who do want to hear more from you, where's the best place to go? Is it your work at Gavical? I know you've written some books as well. Where should people go if they want to hear more from you?
Yeah, look, my latest book is a bit dated now. It was published in 2021. It actually still doesn't read that badly, so I don't mind advertising it. It's not too embarrassing. It's called Avoiding the Punch. You can get it on our website, but our website is gavekal.com. That's GAVEKAL.com. That is the best place to find out about what we do. Most of what we do is geared towards institutions. We do have a private wealth arm in the U.S. Called Evergreen Gafcal, so that's another website. We also have a private wealth arm for non-U.S. investors. We have offices in Mauritius and Dubai for non-U.S. investors, and there's stuff on that on our website. You can sign up for our newsletters there. I write every now and then on Twitter, but to be honest, like I go in and out of Twitter. You can look me up, Louis Vincent Gave on Twitter. You can look me up. You'll find me there.
Great. I'll put links to all of that in the description below. Thank you once again, Louis, for coming on and sharing your knowledge with the audience.
Absolutely my pleasure. Great to see you.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver Gold Osmium. Go to arcsgo.com and contact the owner, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.